listen to me. A year ago today, the NASDAQ peaked. The world we thought we knew came to an end, and the highest of growth stocks began their slow motion crash and burn. Look, even on a good day like today, and it was a good one, with the Dow gaining 398 points, the S&P advanced 1.36%, the NASDAQ climbed 1.36%. Doesn't come close to erasing the trillions in lost wealth that we've seen. So we can't let one strong day throw us off the real narrative of the last year, which is big losses for your portfolio. Sell. Much of these losses are concentrated in businesses that are hidden to you and sound very confusing, not exactly like each other. Enterprise technology, software companies that help other businesses do things more efficiently, or that help you digitize whatever hasn't already been digitized. Now, here I'm talking about tech that was meant to remove the friction in banking or real estate or car buying or anything else. Others are companies that started small in one cloud vertical and then expanded to other cloud verticals, creating newfound and, yes, indeed, ruinous competition. Meanwhile, we've got some gains, too, though only in a handful of what I call prosaic companies, the drugs, the foods, the trade-down retailers, just enough to justify saying that there is indeed always a bull market somewhere, but not very much of one. And what created this new market? The Federal Reserve, that's who. 1 year ago is when the Fed decided to take away the proverbial punch bowl, declaring war on the worst inflation in 40 years. That's the only common explanation for all these declines, because in many cases, the underlying financials really didn't change, at least not in the first 6 months. Now, we can start with big tech. Let's call it FANG plus M&T. I don't even care anymore. These used to be some of the most durable stocks out there. Even when the economy got weak, they got hit with a hurricane of wealth destruction this time around, though. For ages, nothing has been able to stop Amazon, not since they first branched beyond books. But then they expanded too aggressively during the pandemic, right before the Fed started tightening aggressively. The stock's now sunk from 179 at the close on November 22nd last year to 93 bucks, because they've got huge exposure to advertising and cloud infrastructure. These are two areas nobody wants to touch in this market, because advertising has softened, as it always does, as a recession bodes, and Amazon finally got real cloud competition, not just from Microsoft's Azure, but lately Google's cloud offering. Longer term, though, I think Amazon can recover after the Fed's done its job.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com. Or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.